Kant, head of equity research at Cholamandalam Securities. Dharmesh, IT stocks, cognizant numbers came out and IT stocks have been rallying for the last couple of days. How do you look at these factors?
Yeah, good morning, Mangal. Thanks for having me for the show. I mean, IT stocks is more of a tactical rally, which we have seen for the last few days. And still the debate is on. But to our mind, I think going forward, this rally will fizzle out maybe 5-7% more from here. But the business per se has just now Cognizant said that there's a pricing pressure being there and this is going to intensify going forward. And most of the players will be vying for the enterprise deployment share for AI modules. And that is where the margins are likely to be squeezed further. Right now, they are not revising the margins downward, but our sense is going forward, say, in next 2 years time frame, 200 basis point at least will be depletion in the margins for all the IT companies. So having regard to that, and most of the deal wins which are happening are basically replacement of original SaaS wins which they were having. So they are AI-led deal wins. So the vacuum which has been created by earlier deal wins, which is not getting renewed, is through AI wins at a lower margin. So that's the trajectory for all the major IT players. We have not participated in this entire tactical move, and we are staying away from the IT space completely. To our mind, it may be trading blips in between, but nothing structural in the making.
You also say that what you're seeing on IT play out is much tactical in nature?
So short-term wise, yes, it could be tactical, but I sense that many of the stocks are breaking out into their own domains of strong uptrend. Now you look at so whenever a sector starts to go into a revival, you require leadership. Now the leadership is there. Tech Mahindra is one of the best performers. Coforge is the best performer in the mid-cap IT names, and of course Oracle Finance, which has been a performer much earlier. So that quality which is required for a sector to go into an outperformance is there. Of course, the news and the events are not backing out into the sector to come out and say that this is a full throttle rally for the entire IT sector, which could last for another few quarters. So there's got to be a point where these stocks would go into that question mark where the short-term charts could be overbought. They may go into a correction. The skepticism may increase into the stock price, and you might see more staggered leaders emerging from the other underperformers. So you'll have to be a bit picky as well as choosy in terms of picking the right set of stocks in the IT names. But I strongly sense that the worst for the IT stocks is behind. What we saw for 26,000, 25,000 is a support on the IT index from a correction of 45, 50,000, I think, on the IT index 2024. The worst is behind. I think now it's a good time where you might probably want to cherry pick these names at the current juncture. And just to add a point, this just 6 months back, 2026 start, we were at 40,000 on the IT index. We fell down to 26,000. In this last 1 month of rally, 15-16% rally, we are still at 31,000. We've not even crossed the 2026 high. So that skepticism, that negativity over the last 1.5 years, which was built for the IT index, we've just stepped into that first path of recovery. The major part of the recovery will generally happen once the news flow starts to become positive.
So it will be large caps or mid caps which are going to do the rally here, because last leg we saw the mid caps rallying and the large caps being subdued and underperforming. Now we are seeing Infosys and TCS and others doing the rally.
There's this very interesting thing about IT index that over the last 10 years or so, majority of the rallies first have been initiated by mid cap IT names. They've always been the stronger performers first, and that's where confidence, once the confidence gets strengthened into the IT index, you see the large cap stocks participating. The broader part is, even from 2020 onwards, the mid-cap IT stocks have given you returns which is more than, I think, 5x, 6x, some of them in 10x. But the large-cap IT stocks have given returns from 2020 lows of 2x, 3x broadly. So they have moved up higher, but then in variety of phases, in different phases of bull markets within this last 6-year period, mid-cap IT stocks have outperformed.
Okay, that's the take on IT. Let's move on and let's talk about some of the earnings reactions as well. In Asian paints, a lot of brokerages are reacting to the numbers. It's a little bit of a mixed bag in terms of a reaction. While there has been strong Q1 execution, the margins are beating the guidance as well, despite the raw material inflation. Management also has reiterated that 8 to 10% decorative volume growth guidance for FY27. Inventory gains, cost efficiencies, all have managed to support the profitability for them. And the Q2 demand trends and crude prices remain, of course, the near-term key drivers. Dharmesh, for the paint companies specifically, crude is really turning out to be, the devil here. But how is it that you're looking at names like Asian Paints right now, given the kind of underperformance that one has already seen play out in the sector?
Yeah, good morning, Aisha. I mean, look at Asian Paints for the last 3 years, the stock price has done nothing. I mean, 3,300 was their previous high. From there, it has corrected and it's been languishing in a range for quite some time. So what is our understanding is entire this consumable space. It can be FMCG, it can be durables, it can be paints and anything like that. If your ROEs are less than 50 and then your growth is in mid-teens, so market is not willing to give you a valuation multiple in excess of say 35, 40 times PE multiple 1 year forward. And that is where the catch lies. Though the numbers were particularly good for Asian Paints this quarter going by. One is helped by the extended summer which we had. The monsoons were delayed. So 9% decorative paint volume growth was there. Value growth was 16%. Industrials were catching up. But the competition is intensifying. All of them have taken price hikes. So that yielded in the better margins for the company. So this structure will continue. It's not going to falter. But valuation wise, I mean, 5-7%, 10% from here, 2,700 to 3,000, 3,100 is still doable going into the festive season in the month of November. But that's the upside cap. Until the valuations get justified to the ROEs and the growth multiples, and growth would be 15 to 17% at best, not beyond that. So as a trade, you can always take it, but it's not a structural buy anymore.
Dharmesh,
Okay.
one company which I want to discuss is SML Mahindra. We saw the stock up 20% yesterday after that division was sold by Mahindra at book value to SML. Do you now see revaluation of SML from a point of view of a pure CV maker, something like a valuation of what a Tata Motors gets or a Ashok Leyland gets now?
Mangat, our sense is CV cycle as of now is picking out. Though there was a surprise when Ashok Leyland reported numbers. So we were expecting it to be done by the month of March itself, but the momentum continued. But this 1 year forward, there would be some slowdown in the entire CV space. It's a cyclical business anyways. So that's the reason why we are staying away from the entire CV space, be it Tata Motor, commercial vehicles or Ashok Leyland, or now this has also come into the foray. But volume-wise, we have to see how much this SML, CVs are sold into the market. They have not been a market share gainer because most of the bulk has been market share has been gained by Ashok Leyland. So in light of that, how they perform is to be seen. Valuation-wise, some comfort is there, but this entire year, 1 year going forward, we are not interested in CV space at all. Rather, passenger vehicle space is what is exciting.
Well, the other actively traded space of late has been Realty, and a lot of news flow around Realty from last evening as well. Look at a Brigade, for instance. They've acquired a 2-acre land in South Bangalore. They're looking at developing a residential project, which is touted to be around 400 odd crore rupees. Oberoi Realty, they've signed a development agreement. They're going to be developing a land parcel in Malabar Hill in South Mumbai. So that's the other stock which is in focus. And Kunal, you've liked the Realty plays off late, right? Anywhere where you still see further headroom, something that one can still buy?
So I think Oberoi Realty at current levels is something which traders can still buy. I think it's fallen almost 100 points from its recent highs, 1960s or 80 thereabouts towards sub 1900 levels for the stock is trading right now. Godrej Properties also I think has corrected by almost 7-8% in the recent past. DLF is trying to come out of a downward sloping trend line. It's yet to break past about the last 1 week, 10 days high. 685, 690 for DLF was the high for the stock price, currently at 670 thereabouts. So there are many of these stocks which are still looking quite positive and attractive on the real estate pack. It's just that the ones which have run up, the likes of, for example, Phoenix and few of the other names which have run up exceedingly high, the risk reward is a bit off into these stocks or buying into these names. So that's why I think you'll probably have to pick up the stocks which were the previous performers, have taken a bit of a rest or a consolidation, and now again could probably be the ones which can carry on the baton forward.
Right, okay, that's the take coming in on Realty right now. Dharmesh, any view on any of the Realty names?
Yeah, actually, it's a tricky space, but it has pleasantly surprised all as far as the bookings and pre-sales are concerned. Even the collection has been very strong in the Realty space, particularly on the premium segment. So after, last 1 year they have languished. They have corrected quite a bit. Most of the stocks. Before that, there was a rally. And again, with the type of updates which we are getting on the ground level for all the projects being launched and the pre-sales booking being there, it looks exciting. We are already, on the verge of initiating a coverage on one of the Mumbai-based realtors. So I won't be able to take the name. But overall, we are very constructive on the space because ground level activity is very, strong. So I will just highlight, all these benefits which have gone into the system through direct, indirect tax and the rate cut and all. So even corporates and HNIs have made good wealth out of that. And one of the consumption space which is being seeing a good traction is even the real estate space, apart from jewelries and consumer durables like automobiles. So real estate, there has not been any sluggish movement. So pick your choose. But overall, I think entire space is emerging.
Aside of real estate, Dharmesh, how do you look at the co-working segment? Because that's growing at a very fast pace and the good yields also coming in.
Yeah, definitely. One is the valuation concern on the co-working space. Most of the listed player, the valuation is not comfortable. Secondly, we are in the camp as because why we are not liking IT as a play on a structural basis is because of the AI development which is happening. So right now, GCCs are working. Basically, if you go back, Mangar, 20 years back, it's nothing but a KPO which is now being termed as GCCs, and those spaces are working. But our sense is eventually 2 years, 3 years down the line, most of these jobs will be eaten up by the AI enablement. So what will happen is if you need 10 people, you will need actually 2 or 3. Then there is a high chance, high risk that these spaces won't be that productive because the capacity, it will be oversupplied, as has been the case with retailers. With e-commerce coming in, most of the brick and mortar stores even in the malls, their footfall has fallen significantly and they are not earning more. What they are earning is through online portal. So that is where the fear is, and that's the macro theme. It may be a trade in between, but structurally we are not very clear how it is going to play out. Our sense is it will play out in a negative direction.
Dharmesh, within the real estate, we spoke about some of the companies which are in the housing space, but what about the commercial real estate part of it? Have you looked at some of the players from a commercial real estate?
No, primarily we have looked at from residential play. And all the plays like Overall Realty, then Raymond Realty is there, Lodha is there. So among them, we have been looking into seriously.
Okay, just looking at what else has and happening in the market. And of course, while there is the one end of the market which is completely focused on this move that you're seeing on IT, but there were the other winners yesterday as well. Look at a Geofinance, for instance. That's seen a big breakout, over a 5% of a move. Swiggy has been holding out very well ever since concerns around downtrading of the Zepto grey market premium has been on. You are seeing a big move come out on both Eternal as well as Swiggy, and I think Swiggy is due to report its numbers as well today. But Dharmesh, still liking both the QCom players, or is there still a tilt towards any one of these names?
I may be sounding a bit bearish again, but the fact remains, even if you look at Eternal, which is the best player in the market with a better set of numbers they've reported. So this time the Q-commerce margins were at 0.6% from 0.3%. Management is guiding for around 3% kind of adjusted EBITDA margin. So even if I accept that for next 3 years, so FY29, they are projecting adjusted EBITDA of around $1 billion. That is around 9,500 crores. Even at that multiple, it is 32 times, 33 times current enterprise value. So, and then you want a compounding of 20%, 30% to justify such kind of a valuation. So what happens typically is all with new age companies, when they come up and they don't have a profit in place. So it's always a multiple of sales. But the real problem starts when the profit starts trickling in. X of other income, which is the cash which is sitting on their books, and treasury income is there. If you remove that and then pure business play, if you have a profit, then market realizes what's the valuation multiple we are giving and what's the growth rate. And that is where the trouble will set in. So at 300, 310 Eternal, or Swiggy is now fast catching up, even if they turn EBITDA positive and maybe PAT positive. But to justify even this price level going forward would be a difficult and tall task. As of now, I mean, the trade is playing out, so people who are trading, they can enjoy it. Kunal can best give you the momentum guide, but we are not in this space. We are totally out of this.
Kunal, Swiggy is it? Or still eternal?
No, of course, Eternal is the best one out of the two, but I think even Swiggy is making a comeback. So I think now it's a matter of risk reward for someone who's looking to buy. The only difference in terms of behavior for Swiggy and Eternal is that Swiggy is a very volatile stock. It has a tendency of going into a sudden 10% correction. The liquidity is a bit dry for Swiggy as compared to Eternal. Eternal doesn't go into those sudden shocks in terms of price correction. The stock prices are a little bit more stable. So there are different types of traders who are keen into these kind of stock prices. I prefer Eternal at the current juncture because of the fact that the stock has shown very good strength, durability, strong resilience in the tough of the market times, and a very good comeback in the last 2 or 3 months.
And it's slowly catching up to its previous highs, already sitting above that 310 mark per share. But on that note, let's take a very quick break. When we come back, continue our market chat with Dharmesh Kant and Kunal Bothra.
Welcome back. You're watching the market, and we still have with us Dharmesh from Cholamandalam Securities. Dharmesh, the other sector is the NBFC space, where we've seen decent amount of the numbers have been decent for that, whether it's Tata Capital or Geo Finance, which are there from the new companies which came into the market. How do you look at that?
Yeah, definitely. I mean, the entire BFSI space, including NBFC, has reported a very strong set of numbers. So we are constructive on the entire space. And this is the only space where you have a valuation comfort. Despite, a strong set of numbers they have been reporting, be it public sector banks, private sector banks, or the NBFC space, or even the housing finance companies for that matter. So Geo Financials, we are pretty constructive on, given the growth trajectory they are pursuing. As of now, the book is very small, but going forward, I think it's a business in the making. So we are more positive between the two. Geo Financial would be the preferred pick. Otherwise, I mean, the entire space looks very attractive to us. And I think this is one space where actual valuation re-rating will happen going forward, maybe the second half of FY27.
And how do you look at some of the renewable space as well? Acme numbers came in strong 60% YOY EBITDA growth, which came in on the back of BESS. And maybe worry as well, if you can give us some perspective there as well.
Yeah, I mean, entire renewable energy space, be it IPP or the module providers or the producers. The problem is 1, 2 years, next 2 years, the numbers will keep on coming strong because of the pre-order book and the capacity expansion the IPPs are taking up for that matter solar when they will be executing it. But beyond that, beyond FY28, the trouble starts when the incremental inflow of order has not been strong. And the valuations are far ahead of what the numbers are. As I was just discussing about Eternal, so it will play out in the similar fashion. And that's the reason why last 6-7 months you have not seen any price action in, for example, Waaree Energies, despite the numbers being very strong. And it's a very crowded space as of now, but the real problem starts when Adani and Reliance will start 20 gigawatt kind of a capacity module manufacturing when they will come into play. So module manufacturers, that will be a big challenge for them. Margins, Waaree Energies, you have already seen a depletion starting happening. That's likely to continue. And for power segment generation, I mean, valuations are way too high. They are already discounting FY29, 30 kind of a numbers. Rather look at all these HVDC players like Hitachi, Siemens, Energy, and the GE, Vernova, T&D. There, I think still the capacity addition is going to be double from 33 gigawatt of more HVDC transmission lines has to be laid down, and there 2 lakh crores of overall market opportunity is there. So even they are expensive, but I think they are likely to command a good business premium going forward because the business flow, they will be doubling their profits in the next 2 years' time.
Just hold on. We'll just look at what happened to the Vedanta's demerged businesses, which came out with numbers. They delivered a mixed Q1. Iron and steel and oil and gas posted strong growth, with both businesses swinging back to profit. Power, however, remained the weak spot, reporting a net loss and a sharp drop in margins despite healthy revenue growth. Sesha joins us with the highlights.
First, let's start with Vedanta Iron and Steel, and they have reported strong set of numbers. Revenue has risen by a solid 18% on a year-on-year basis. Margins, meanwhile, have also expanded to come in at 13.9% in the quarter gone by. Now, this revenue growth was aided by higher production that the company reported in the quarter. So, the company recorded highest ever quarterly pig iron production, which rose by about 8% YOY. Iron ore production also saw an increase of 4%, and saleable steel production also rose by 4% on a year-on-year basis. Margin expansion this time around of 300 basis points was aided by operational efficiency along with better product realization that the company saw. Let's also talk about Vedanta's oil business then, and their revenue growth of about 8.5% coupled with margin expansion of about 1000 basis points to come in at 32.5%. Now, one of the major highlights of the quarter gone by for the oil and gas business was the exploration success with gas discovery in Rajasthan's area, the Barmer Basin. The company had earlier informed the exchanges about this, but this was one of the important takeaways of the first quarter. Other than that, the capacity expansion plans continue to remain intact, so that is another positive. Let's also talk about Vedanta Power then, and over here, margins have contracted and company has reported a loss on the bottom line to the tune of 400 crores versus 88 crores that the company reported same time last year. Management says that the revenue was very strong in the quarter gone by. Power sales were on the higher side, and the capex plans of about 600 megawatt unit 2 of Sakti plant continues to remain on track for commissioning. So Vedanta Power has reported weak set of numbers, but other than that, Vedanta Oil was in line, and Vedanta Iron and Steel clearly has reported a strong set.
Dharmesh, do you have a take on some of these demerged companies, the oil and gas, iron, steel and power of segments of Vedanta?
I'm sorry for that because I did not have a deep dive into each of these verticals. So we want 2-3 quarters to roll out first, and then maybe our call can be taken. So, however, we are we are having a positive or constructive view on Vedanta Limited, which is the copper, zinc, and Hindustan Zinc comes under that.
Another set of numbers that came in is from Quess Corp, which reported a strong set of first quarter, beating estimates on revenue, EBIT and profits, as all three business segments contributed to growth. Management remains optimistic, citing healthy GCC hiring, strong contract additions and broad-based momentum heading into Q2. Darshita has the details.
Right. Quess Corp has reported a strong set of first quarter earnings, beating the street estimates on revenue, EBIT and net profit, with the growth driven by all three of its core businesses. Now, the consolidated revenue rose 14.5% on a year-on-year basis, coming in at 4,182 crore, while the EBIT increased 26% and the net profit surged 59%, which was ahead of the expectations. The EBIT margins has also improved by 16 basis points, coming in at 1.79%. Now, the general staffing business rebounded strongly, with the revenue growing over 15% and 86 new contracts added during the quarter, while the professional staffing delivered healthy profitability with an EBIT margin of over 11%, supported by continued hiring from the Global Capability Centers or GCCs, and the overseas business posted 17% growth in both the revenue and EBITDA, driven by strong demand from the Middle East and Southeast Asia. Management has also announced the launch of a new Indo-Japanese corridor to support the GCC expansion and the cross-border skill mobility. Now, one area to watch is how is the finance cost, which rose nearly 46% on a year-on-year basis, coming in at 14.4 crore for this quarter, above the company's guided range. Now, even so, Quess says strong hiring momentum across staffing and the international markets has positioned the company well for the quarters coming ahead.
Thanks, Darshita. Osho Krishnan also joins us. But before that, Dharmesh, the GCC play, while it may be negative for Indian IT services company, there are services which are offered to the GCCs, and is that a play because the kind of GCC which are getting set up in India, and almost every week we are seeing one GCC coming into the country. There are services aligned with them. Is that a play?
Yeah, but how you play it out? One is to the staffing services company like Quess Corp or infosys. So there we are seeing a good traction happening. Even infosys reported when they gave out the business update, it was a very strong set of numbers which they came out. So maybe indirect way of playing that theme is through Quess Corp and infosys. The numbers were actually very strong for Quess Corp. for the quarter gone by, and the commentary also remains very constructive on that aspect. So I think indirect play for GCC is Quess Corp from infosys for the time being.
From Dharmesh, before I let you go, you briefly mentioned about the HVDC play there. Within there, do you see the larger players benefiting more, or the mid-cap players benefiting more?
It will be larger players who would be benefiting more because it's a very specialized kind of a system, and the technology rests with the most of the MNC players. So for HVDC, technology is either with Hitachi or with GE or Siemens Energy. It has not, none of the Indian companies possess such technology. Some of parts of the component manufacturers, they are suppliers. One of them is a good company, but going forward, I think because still there's so many solar power generated being lost, it is not getting transmitted into the system. Almost the last report which was tabled in the parliament was 3 gigawatts. So most of them will be through HVDC because the transmission losses are very less out there when you are transmitting through HVDC lines. So that's the reason why we are more constructive on the larger plays. Valuation may look expensive as of now, but if you think of doubling of the profit in next 2 years, then again these valuations are justifiable. So play a basket. Don't select a particular stock. So Hitachi, GE looks good in that place.
Thanks for joining us.